Welcome and good afternoon, or good morning or good evening if you're a long way east of west or west of London. You're helping to make history today because this is the very first Association of Corporate Treasurers video webinar. And today we're going to be talking about risk management in times of unprecedented uncertainty. I'm Will Spinney, I've got my makeup on ready, and I work in education here at the ACT. I'm going to be chairing the discussion. I thank Lloyds Bank for sponsoring this event today. It's one of many for them. This webinar will last for 45 minutes. Well, treasurers are supposed to be good at risk. We put a huge emphasis on it in our qualifications, and we're going to take this even further than that today. I hope that you enjoy it. I'm very delighted to welcome from Lloyds Jeremy Adam, Head of FX Market Solutions, and Yuri Polyakov, MD and Head of Financial Risk Advisory. I'm going to be asking the questions, but you have the chance to pose your questions to these two gentlemen as well. You'll see a button on your screen that allows you to ask those questions. We'll try and tackle them as we go along, so please don't wait until the end of the session. If you do ask a question, we won't mention your name or company, so feel free to ask anything. So, here we go. Well, my first question is really, well, what is unprecedented in the risk landscape today? I mean, things seem to be going quite well. Treasurers can raise money at low prices. There's plenty of liquidity in the markets. Foreign exchange has been in these ranges before. The stock markets are happy, and even Brexit doesn't seem to be causing too much of a worry to anybody.
It sounds a pretty safe place to be. I think I automatically defer to the professionals in this case, and the professionals in the world of what systemic risk is all about. And for me, that's the IMF, the World Bank, the World Economic Forum. They publish their guide to systemic risk and their reports on systemic risk every year. And I think even more interestingly, if you look at the IMF's spring meetings this year, they absolutely didn't paint quite as rosy a picture as you just have. In fact, they focus very heavily on what's the impact of a 20% increase in the value of the dollar. What's the impact of that on forecasted GDP growth? US start marking GDP growth forecast for 2015 down, and Europe and Japan start getting marked up. Is that an advent to currency wars all over again? They then add Greece, they then add the Ukraine, they then add China, a new world economic power and a new potential international reserve bank, AIIB, as its an acronym is. So all those things to me say, no, this is not necessarily as comfortable risk landscape as perhaps people might perceive it to be. I think also what we should do is we should look back historically at what has been systemic risk and see if we can map that to the professionals in the way they look at the world. If they talk about systemic risk as being economic, technological, geopolitical, societal and environmental, have we actually seen things in our markets, the markets the treasurer focuses on, that you could itemize as being those systemic risk categories? So let's start with the foreign exchange market. I would, wouldn't I? Swiss franc. The depegging of the Swiss franc, what was that in terms of a systemic risk? To me, that's an exact example of where the market has been told a benchmark or a fixed level exists and it will not move, and they de-risk themselves as a result. The consequence is a new risk is then presented. It's the risk of what happens if that peg is removed. How do you try and measure that sort of risk impact on your business? Three things occur there: the length of time the peg is kept, the lower volatility price of that inherent pegged risk, which the market has to accept, and then the positioning as a result of that peg becoming potentially very unbalanced in terms of those people positioned for a peg to stay there and those people positioned for a peg to move. What we get is a flash crash, and a flash crash combined with some technological changes in the FX market where we've moved to electronic execution rather than necessarily human being voice markets. If we move on to geopolitical risk, I think Russia's a very good example of that. Here you have a situation where one country is faced with a currency crisis and also to an extent a commodities crisis. It's a double whammy effect for them. And what you have also is a situation where local intervention isn't strong enough to deal with that problem. We don't get concerted global intervention in this instance because actually you've got a geopolitical risk going on, which is to an extent some of the rest of the world want that impact potentially, if you read political opinion, to be occurring to that country in order to achieve an alternative political end or humanitarian end. How do you plan for that as the treasurer? You're now dealing with two sets of risks, the political risk and then the reality risk amongst the asset classes you're exposed to. If we move on to environmental risk, I think everyone would remember the volcano in Iceland and the impact that had on the airline industry. Again, no idea how long that was going to last. It's entirely down to nature. But on the graph we've got here, it actually focuses on the cotton price. And again, people may have not stored this in their memory, but here you had a situation where the price rose dramatically based on the natural disaster or weather impact to that commodity asset, shortly followed by an activity of some extent stockpiling the asset and hoping that the price would stay elevated, resulting in a decline in the price, stock actually beginning to rot in some cases, and now you have a systemic risk existing between supplier and user of a commodity and not knowing to what extent the time horizon for that risk would be. Moving on. Societal risk, I think here you have less of a sudden systemic risk and more of a sustained systemic risk, but possibly in a way that we're not familiar with. The graph has got the Greek stock market on it, and I think that reflects, if you would, the sustained systemic risk of political popularity having to be balanced against the real infrastructure and asset markets of a country, and what the impact is to people having to manage their investments, as well as potentially interconnected debt, and this example between the Eurozone as to what sort of premium should exist and what sort of debt management policy people should follow. So again, it's not always a sudden systemic risk. It can often be a sustained systemic risk that people have simply not been able to prepare for, unplanned or relatively new in its nature. Technological risk. We've got a graph here of Apple's share price. Here I think you have a situation where you could look at individual companies being exposed obviously to their own market from a technology standpoint, but also what policies do they follow because of their success in this instance in terms of surplus cash and surplus cash held abroad, possibly not moved back into America because of potential tax implications, surplus cash held potentially as a defense to competition in the technology market, but also a demand from investors to be returning cash to shareholders. How do you look at managing all of that, and what's the precipice potential for your technology to either be attacked by some sort of cyber hacking event and or competition coming up with something that causes a systemic market shift because of the technological improvement? So again, I think that's absolutely being able to map all aspects of treasury risk management and what treasurers face back into the world experts in the way they look at systemic risk.
Gosh, this is quite a change for the treasurer, because we teach them to look out for foreign exchange risk, interest rate risk, commodity risk, margin risk, counterparty, whatever, and suddenly we're looking at it quite a different way. Tell me, is there a way that treasurers can find out what the market thinks, that suddenly things might be looking a bit rough?
Well, I think if the information is there, it's very likely to be priced in already. So I don't think there's any magic way of finding out whether the market is expecting a big move or not. There's of course implied volatility of particular market variables that treasurers can look at. There's also commentary, there's also fundamental analysis. But I think anticipation is one of the key skills that the managers should have these days. In trying to imagine scenarios that may be however unlikely but possible, and trying to understand what the impact of these scenarios are, is that where the time is better spent.
Okay. Are there any particular sectors of industry or particular geographies that you might highlight as being most at risk?
Well, I'll let Jeremy talk about the sectors. Geographies is my favorite topic, because we used to think that there's emerging markets where the risks are high, and there are G10 and developed markets where the risks are low. With what happened with the Swiss franc, with what happened with the huge move in cable, we now understand that the uncertainty of the developed markets is no less than the uncertainty of the emerging markets. So I think that the risk landscape is equalizing, but it's not equalizing towards de-risking, it's equalizing to actually risks becoming higher all across the board. Interestingly, returns are not changing. People still expect to make more returns in emerging markets. So you have this dichotomy of higher risk, higher return, and higher risk but still depressed returns. So I think that presents an interesting dilemma for treasurers. But in terms of the industries?
I think in terms of the sectors themselves, we very quickly are able to map particular changes in asset prices to particular sectors. What I've found very noticeable over the last year and a half is you've had a combination of events. So commodities move 50%, oil has changed by, not seen since 2008. Dollar strength, 20%, not seen again since 2008. This has had a combined effect that actually goes across sectors rather than leaves us identifying individual sectors in their own right. And that means you've had two levels of risk for treasurers to get their head around. The direct risk of the immediate asset class that they are in themselves, consequentially the indirect risk of other asset classes moving at the same time that's having an impact on their business through their supply chain, through their customers, in every way which it might manifest itself. That means you've got to start measuring the combinations of risks rather than looking at risks individually in the way that maybe has been the traditional method.
Gosh, there's a challenge for you, Treasurer. It's a message to start understanding your business. Can we move on to thinking about responsibility? Because this is quite a strategic level. So this is the C-suite type area, isn't it? I mean, they'll be reading the newspapers, they'll be finding out what's going on.
I think the responsibilities are changing greatly. I think we used to be in the environment 5 years ago, maybe, where the treasurer would be given the particular level of funding that they need to make sure exists. They would be given particular budget rates that they need to achieve, and that would be the scope of their responsibilities. I think these days the markets become so complex, and the problems that the markets present need to be managed in a very simple way, that the treasurers need to provide the input for the C-suite executives, for the chief risk officer, for the CFO, to help them in the strategic planning. Because ultimately, risk management is becoming all about buying enough time for the company to readjust themselves for a new environment. And I think there, the treasurer's responsibility is to provide the more input higher ups, particularly in the C-suite.
But you could take it even further than that, couldn't you? Because shareholders, investors, they buy into these businesses to take these very risks that we're talking about. So isn't it their risk as well?
Well, it is their risk. They own it. They invest in it. Whether it's their responsibility or not to manage it, that's an interesting question, because I would say that when a shareholder, when an investor buys a stock, buys a company, buys into a company, they buy into the assets and also in the management's way of managing these assets. So I would say if the shareholders have a portfolio of companies, it's absolutely their responsibility to manage the risk of the portfolio of the investments, correct. But when it comes to managing the risk of the particular business, I think it lies with the C-suite and the management of the company to deal with that.
Okay, well, I could see that a treasurer takes a real interest in the strategic type risk that we're talking about, puts up a board paper, which is really good, and then they come back and say, well, okay, that's fine, but I've got too much to worry about. I've got competition, I've got products to think about, geographies to go into. This is next year's problem. What should the treasurer do? Well,
I think first of all, the treasurer should highlight that in risk, there is no such thing as a next year's problem, because the problems tend to arrive way too quickly. And if you don't anticipate things that may happen next year today, you may find yourself in a very difficult situation. Another argument that I would say the treasurer absolutely should bring in front of the board, in front of the C-suite, is the following: that if you do not take the market dynamic into account when you do your strategic business planning, you may find yourself in a very awkward situation. Some risk events are short-term events. Some risk events have much more fundamental impact. For example, now with the Swiss franc is unpegged, that is the reality, which is not going to change back. That will stay there. So some businesses who are impacted by the change of levels will need to rethink their business model, how their margins are impacted.
And if I could add to that, I think historically, and certainly if you look at 2014 and 2015, there is a relatively common occurrence, more common than actually during the crisis, of senior executive C-suite reporting financials with impressive returns that are then adjusted for net of foreign exchange impact. Now, is that a responsibility that the shareholder undertakes? Is that a responsibility that the treasurer should be doing more about? And you get this sort of circle of argument sometimes within companies. The paper goes up to the board. It has recommendations about how foreign exchange risk solutions could be planned for that possibly would help avoid that sort of volatility in earnings statements. And yet you arrive back at other issues that again need to be considered, which is what would be the impact beyond accounting, financial reporting, if certain solutions were undertaken. So we haven't got to the final answer, I don't think, by a long way.
Well, that leads me into thinking about foreign exchange, because we treasurers, we like to think of these things in buckets. And what we teach is that we teach trading, the risk in trading in foreign exchange risk different from the risk of translation. Is this right, or should we be thinking, for the systemic risk, should we be thinking of them more as together?
I think you're right to separate trading risk from translation risk, and a lot of companies will only hedge trading risk. They won't necessarily hedge translation risk. And translation risk has to be known about, absolutely. Again, if we go back to the crisis, there were several instances where particularly debt covenants were impacted by the mere fact that we look at earnings on an average of the exchange rate and mark debt on a single exchange rate at the end of the year. And that severely impacted some people's liquidity ratios and triggered debt covenants. So I do think you need to separate them, but at the same time, we can work with customers about whether through separation that creates any advantages in the adjusting of the risk management policy that you have.
When I was a treasurer, I was reasonably confident about my translation exposure. I had it all on the desk in front of me, and I got my debt in what I thought was the right currencies and so on. But the trading exposures always gave me an enormous amount of problem to try and understand what was going on out there in the business. Do you have those problems with some of your clients?
Yes, we do. And I think if you looked at our industry and levelled an accusation at us, we are sometimes all too soon to talk to the client around risk management solutions without necessarily asking the client, how's your ERP world and how's your access to information, your raw data around what it is that you would actually want to know before you start deciding how you're going to manage that risk. And from more and more conversations, it's becoming apparent that if we start at the beginning of risk management solutions for your individual asset issues, very often the client will take us back to, hang on a second, first I need to nail down my ERP world. And just because this industry has moved forward dramatically in terms of the treasury management solutions that are available, there is still this bridge that we need to identify from a client needs standpoint is something, if we can help, we should be helping clients to solve before we leap down the natural bank route of risk solutions management. Okay,
so there's a message for you to try and understand the risk that actually going on in your company. As I say, my experience was not very good on that account. Mm-hmm. Can I just tackle now the question of measurement of this risk? You see the things that can happen. How can a treasurer work out whether this particular risk is big or small?
Well, I think there are a couple of aspects to that, and I'll give you an example, and sorry for jumping the slides, but one of the simplest ways of doing it is come up with a concept of a scorecard. And the idea here is that, yes, you need to understand whether a particular movement in the market variable impacts your EBITDA or your other KPI in a significant ways. And that is the first important takeaway. It's not about how much the market moves, it's about how much it impacts you. What are the critical levels? What are the risk tolerances? But I also think it's hugely important to give yourself credit for the preparedness. So if you build this two-way system where you look at impact versus preparedness, that it makes you very easily focus on the things that are absolutely need attention right now, and allows you to relax about other things. But ultimately, it's about how market impacts your business. 20% move, as I said, in cable can impact one business severely, another business wouldn't care that much.
Okay, treasurers should note here that the particular diagram you're looking at the moment, it looks very similar to an impact probability chart, which we all know and love, but this is an impact versus preparedness. Okay, how does, do you see a lot of companies using the concept of risk appetite to deal with some of these risks?
I think more and more the concept of risk appetite is coming into play, and I think from two standpoints. One is that people realize that you cannot hedge out all uncertainty on the marketplace. It's just too expensive, it's not optimal. So a company should be willing to take some uncertainty. Some uncertainty will come from business, some other uncertainty will come from movements in the financial variables. The question is, how much of that uncertainty can they take? And that's where the risk tolerance comes into play. Every company will decide by how much their EBITDA can be impacted, by how much interest coverage ratio can be impacted before the consequences become too severe. And that's exactly where the risk tolerance should be. And everything between now and that risk tolerance should be their risk appetite.
Okay, there's going to be quite a bit of science in this in terms of stress testing, and some things you can measure and some things you can't. Can a treasurer do this stuff by himself? I mean, from my own experience, if I had to do something really whizzy, I was always frustrated that I had to go to somebody else to do it. Should a treasurer be able to aim to do this sort of stuff by himself?
I think there are two very good questions there. Could they? Yes, absolutely. I have every bit of faith that if somebody puts an effort and a little bit of money and a little bit of time, you can absolutely do this. But I think it's more efficient to rely on your partners. That could be a bank or a consulting company. It can be a provider of your treasury risk management system, a treasury management system. Treasurers should be able to rely on somebody to help them with some aspects of it, particularly a couple of things. One, trying to understand what the behavior of the financial markets could be. So projecting the scenarios that then would be stress tested. Second thing is overlaying their business strategy onto the scenarios. That can be quite an onerous exercise, as you said. The partner can absolutely help them in doing that. But ultimately, what the treasurers, I think, should remember is that the decisions are theirs. Their partners can provide a lot of information, but they need to make the decisions ultimately.
I think, again, to comment on what Yuri's just said, it helps us amazingly with our clients simply to answer 4 questions with them around any sort of asset class risk management, starting with, we need to know what absolutely must not happen to your company. And we can go away and create the scenarios that might actually look like, particularly in a systemic risk environment. We then need to know what it is in day-to-day business or business as usual that they need to be protected against. And that forms usually the main body of the analysis around their risk and the solutions that are appropriate. You don't even get to the point of, is there anything that you would like to have your company be able to participate in, should there be an underlying market move or an asset class move that would help your company, before you've dealt with those first 2 issues. And then and only then do we ever get to the much rarer environment where some companies will almost seek to use a commercially targeted risk management policy that actually seeks to take advantage out of movements, particularly in implied volatility in certain asset classes.
Okay. Right, let's move on to interest rates now, if we may, because interest rates are extraordinarily low and have been a long time, and we're never really sure when they're going to go up. My own view on interest rates is that it's quite a difficult risk to define. In fact, it's not just, well, if I'm a borrower, I'm going to pay more. If I'm a lender, I'm going to earn less. You might have sensitivity to risk, and there's also pensions to take into account.
I think there are a number of complexities. You're absolutely right. And I think some of these complexities have been underappreciated. Interest expense, of course, goes up for most companies when interest rates go up, unless they have huge cash balances. So that's one issue that everybody understands. Pension funds are a very interesting one, because there's a common wisdom that pension fund is a huge fixed rate liability whose value will go down if the interest rates go up. So as such, if somebody is looking at the optimal fixed floating mix, or considering how much floating rate debt to have in their portfolio, they say, well, I already have this big fixed asset, a fixed liability, I can have more floating. I'd like to caution about that approach, because fundamentally, yes, the relationship is correct. However, if the interest rates go up, yes, the liability will come down, but interest expense will go up. You will have to pay more money. So people need to be quite cautious about that. The other interesting point about interest rates, which I don't think a lot of people do take into account today, is that cost of doing business when interest rates goes up not only because the interest expense goes up. Think about your cost of capital. Cost of capital has cost of debt component, of course, but even cost of equity has the risk-free rate, so there is an interest rate component there as well. So your overall cost of doing business, your cost of capital comes up in a rising interest rate environment. That needs to be taken into account, I think.
Okay, do you think some sectors have just sort of got this sorted? I mean, people like utilities or transport companies with their very high asset base, and property companies, they're pretty much fixed. And perhaps the oil and gas explorers, they're pretty much floating, they always have been. Has it settled down sector by sector?
It has definitely settled down, and there has been, as you say, there has been a tradition, and this is how people traditionally manage the interest rate exposures. However, I would not be surprised if this changes going forward. We've just been through an unprecedented period of very low interest rates. And don't forget, it's not only about the LIBORs being low, it's also about the yield curves in Europe, for example, being practically flat. the moderate steepness of the sterling curve and quite a bit of a steepness in the dollar curves dictate the trade-off between fixed and floating is quite different in these yield curves. So depending which currency you fund in, depending what is the duration of your portfolio, depending what is the duration of your asset, people may choose different strategies. And I think what's really important is not to trivialize that conversation to I want to be 30% floating, 70% fixed. Look at your funding mix, look at the dynamic of the yield curve that you're exposed to, then make decisions that make sense.
If I could add to that as well, being an FX person and not necessarily a rates person, there is an FX market sitting there waiting for not necessarily the incremental change in interest rates, they're waiting for the impact of change in interest rates, namely interest rates rising. And again, going back to the IMF spring meeting, it was opened by the head of the IMF saying there will be systemic risk when interest rates start to go up. It's almost as if they are ready for this because they believe there's a good chance of a liquidity issue occurring as you get a rush potentially for the exit. Well, the foreign exchange market is sitting there waiting for exactly that because there'll be expectation around flows moving out of EM back into dollars, dollar debt having to be covered, paid off. That's going to attract very likely hedge funds, speculators, and consequently the treasurer who thinks they may have got the interest rate risk management under control may very quickly have to turn back to the FX risk.
Yes, I remember reading the words recently. A super taper tantrum, I think, was how it was put. Do you think low rates are just ingrained into our consciousness now? And it's effectively been 8 or so years since, or 7 or so years since we've had really low interest rates. Do people remember them? There's been turnover of staff. So, how do you think that's a factor?
I think people are absolutely used to low rates. There's no question about it. And the debate between funding with floating and funding and fixed, where the rates are very low, is absolutely there. But I think the fear or consciousness of rising rates is always with us. If you think about this last 5-6 years, every year somebody would have said, yes, rates been low, now they're about to move up. Now they're about to move up. We're still in low rates, and just today we're seeing a lot of commentary that's saying that the rates are not going anywhere this year. So I think we quite possibly going to stay in the low rate environment, but the awareness of what will happen if the rates go up absolutely must be there.
Okay, thanks. Well, I'm not going to spend time on commodity risk and so on, but one question that has always happened to me is that we're expecting treasurers now to be very much strategic, but do you expect them to actually forecast interest rates? Should they be required to do that as part of their job?
Absolutely not. And I think treasurers are in a very difficult situation sometimes where the boards, the C-suite, does ask them for forecasts. They ask them for their view of the market. They ask them for their view on rates, on commodities, on effects, on everything. But I don't think it's the treasurer's job to forecast. I think what treasurers should absolutely do is get themselves 2, 3, 4 favorite economists that make sense to them, preferably to me that have opposite views, so they can give the C-suite and the boards different outcomes. I think what should absolutely be the treasurer's job is to stress test the business strategy, not just the business the way it exists today, but the way it may exist in 2 years, in 3 years, according to plan, under the different potential scenarios. That, I think, is absolutely the treasurer's job.
Yeah, there's a technique for all you guys out there, stress test, to see what your business might look like at different market conditions. Okay, we've had a look at the identification of risks, we've had a look a bit at the measurements, we've had a look at the sort of risk going to rise. Let's think now about what responses we might make to some of these risks. Does the treasurer just jump to his toolkit? I mean, that's a natural thing to do. Jumps to his toolkit of hedging instruments. Should he do that?
I think absolutely not. I think, number one, the treasurers need to be very careful when they think about risk management. Do not just limit their thinking to hedging, because risk management is a much broader exercise of first identifying the risks that the company faces, then, as we discussed, establishing the risk tolerance, and only to the extent that the exposure is higher than the risk tolerance, undertaking the hedging exercise. And if you look at this diagram in a kind of normal market environment, you would expect the treasurers first to model or understand the market uncertainty, then calculate the sensitivities of the business to this uncertainty, then establish the risk tolerance, and then hedge. Well, that used to be a great way of doing things. The problem we have now is that the market is so unpredictable, and that's the theme of today's talk, is that it's very difficult to model it. All the ways, in every way that people try to predict things have proven not quite adequate. So what do the treasurers should do today? I think they should start with risk tolerances. So forget about where you think the market will go. Think about where the market could go and understand what are the levels that become absolutely detrimental for the business. Once you've done that, you can solve for the required hedging, because then you know at which level you need to be protected, and then you optimize the hedging exercise. So I think that should be the new paradigm.
And if I can add to that, and you just said we don't have time for commodities, I think it is worth highlighting, though, that in the last, again, 18 months, let's say, we've had an unprecedented increase in commodity hedging by both in terms of the natural users, but also users who we've really never seen before, who are taking a systemic view of the value of hedging energy costs, either directly or indirectly in their business. And if, as an indicator to the audience in general, whereas a foreign exchange business in the last 18 months might have been 90% of the activity and only 10% commodities, we've had a shift to at least a third of that activity, particularly for the global corporate segment, shifting to commodities.
That's fascinating. So what is the response? And in your top row picture there, you've got hedging. What are the strategic responses available here?
Well, one of the things that I see people start considering more and more is using optionality rather than using the forwards. And a couple of points I would make here. Number one, when I start talking to treasurers about using options, sometimes they just tell me, well, we're not ready yet, we're not ready to spend money on premiums, accounting can be tricky. I absolutely get that. But my only response to that is get ready to use options. There are a lot of reasons why optionality may be a better choice, especially in the markets that are this volatile, especially in the markets where you're only hedging the tail events. Options may be a better product to use. However, I perfectly realize there's a long road from traditional hedging methods into optionality. At least get them into the policy. Start getting the framework right, which will allow you to decide when to use options, how much it's not much to pay, and how do you evaluate the effectiveness of the options-based hedging program. So that would be my first response.
Options have got this traditional thing, gosh, they're expensive. I'm not going to get those through the board. What do you say to that?
A couple of things to that. I'll let Jeremy talk about the product perspective, but from the C-suite perspective, insurance can be expensive, especially if the threat is too big. There are different ways of minimizing the cost of options. For example, you do not hedge at the money, you hedge deeply out of the money. We keep talking about the risk tolerance. I think realistic risk tolerance is hugely important, because the more you're honest with yourself about how much volatility you can take, the cheaper that optionality will be. The other thing is, we haven't talked about competitiveness much, but if you use a traditional forward-based hedging methods, you can find yourself over-hedged compared to your competitors, and then your margins will not be as good as theirs.
Yeah, I'm sorry.
No, I was going to say, people know there's an index called the VIX, and the VIX, historically, when you look back, has reacted as you would expect it to market events. But it identifies exactly why it is a lot of people don't like paying for insurance after the event has occurred, because it's a multiple of the cost to them. And yet people don't often pay for insurance before the event because the reason is not there to pay for it in the first place. So I think this brings up various things that we may continue to talk about, but this idea of safety in numbers, the herding type mentality, and not being seen as an outlier because the outlier is at risk of being picked off. What Yuri has just described in terms of a risk management policy looks at the outlying events as being the real risks you need to prepare for, whereas the herd is business as usual, and we can deal with that sort of environment.
But isn't it so tempting for management to say, well, what are my competitors doing? What's the peer group doing here? I don't want to be too far away from the peer group, because then nobody's going to invest in me. Nobody's going to take the risk of me.
It's hugely tempting, and we absolutely know that it's always a factor in decision making. But I think the peer group analysis and the best practices should be the constraint rather than the driving factor in this decision making. I think every business is different, and yes, peer groups are there, and some businesses are more similar than others. But I think every business has their own business strategy. They guard their business strategy very, very tightly for a reason. because they have their own advantages, they have own angles at looking at things. Same should be applied, I think, to a risk management strategy.
I mean, there's a lovely example of that. If we go back to the technological systemic threat, the US is passing or seeking to pass a bill at the moment that deals with cyber hacking threats, having some sort of an agreement in place, which I think they put a cap of 7 years on, where companies who share their experience of a cyber hack become relatively immune to any consequential prosecution. And that's already got massive issues in terms of a bill being able to pass all the way through to presidential sign-off. But that surely to me is, that there's a right reason to be doing that because it is a form of defense. There'll be a wrong reason to do that because there'll be issues about, I'm sure, campaigns against that sort of information access. But at the end of the day, that herd mentality, I think, is risk systemic in its own nature. And go back to Treasury risk management policies, hedge 50% of the FX risk, leave 50% of it open, is out of date in the world we live in today.
Right. Okay, let's turn to a couple of questions from the audience, if we may. One of them actually relates to your risk preparedness diagram, and he wants a little bit more explanation to what the colours mean.
The colors mean when it's red, it absolutely should be focus of attention for everyone from the treasurer to the C-suite. If you think of the way the diagram works, if impact is high, so severe in this case, and the preparedness is low, so current approach cannot prevent the event or condition, then it's absolutely red. If you think about green, either the impact is low or the preparedness is high, that's not something that you can or need to spend your time in. And when things are in yellow, that means it should be a point of concern, but no immediate action is required.
Great, okay, thanks. And I encourage you all to start posing any more questions that you have. We've got about 10 minutes to go. Now's your chance to ask the experts. And another question that we've had in is about bank sympathy, and I think this is a credit risk question. Well, are banks going to be more sympathetic if there are going to be more volatility in FX gains and losses in the accounts when they're judging you from a credit risk point of view?
Is the government going to be more sympathetic?
Not necessarily the government, but the
the banks.
their credit risk.
Well, I think what's really important is to understand that ultimately FX risk or any other financial risk is a fundamental part of the business's ability to generate cash, to generate revenue. And I'm not a credit officer, and it's very difficult for me to judge what the bank's reaction would be. But if I had to look at the riskiness of the business, I would say the following. Some minor FX-driven volatility, which brings the earnings closer to covenants, maybe a little bit less than last year, driven by FX, where the FX is considered to be a recoverable situation, so it moved down 10%, everybody expects it to move back up, probably is much more acceptable than if people start thinking that there's a fundamental shift in paradigm. Swiss franc, for example. If there are businesses who are fundamentally impacted by the fact that the currency is not pegged anymore, the reaction to that probably would be more severe than something that 5-10% move in cable.
And then I would add to that, there's a second conversation around credit limit utilization and availability. When you have the sort of moves that we've had, say particularly in the oil price, going all the way down to $50 a barrel, a lot of hedging took place at very good levels as far as people's businesses were concerned on the way down. But nobody was necessarily expecting it to go to $50 a barrel. Otherwise, we wouldn't have seen the hedging at 80, 70, 60. Those hedge positions start to accumulate a negative mark to market as the price of oil continues to move lower. And yet it's continuing to move to a better and better level for the business dynamics of our clients. In which case, how do we deal with the credit issue and the credit limit utilization and the value opportunity for our customers?
Yeah, this is a challenge. One response to these sort of systemic risks could be just to sit on cash. I mean, we're seeing so many more companies with large amounts on their balance sheet. You mentioned Apple, but of course Apple is a technology company, very risky, and arguably it shouldn't be geared anyway, but lots and lots of companies have got more cash than is efficient for them. Isn't that a good response to this sort of risk? Well,
as you said, some cash is absolutely great and essential. And the saying goes that every company that's ever went out of business for one reason only. They ran out of cash. So holding some cash or in fact some liquidity line, because you can have the liquidity support through other means than just cash. So having some liquidity is absolutely great. Having too much liquidity, probably not that great. And it's not only because of the negative carry that we're all very familiar with, where your cash yields much less than your cost of capital. But if you think of inflation, which right now is at 0, but still it can go back to 2-3%, your cash balance loses value at inflation every year. So I think one of the huge things for the treasurer to do is to understand what is the optimal liquidity level. Now, how do you do that? I think the framework can be quite simple. You, from the business plan, from the business strategy perspective, you look at how much time do you need to react to particular fundamental shifts in business, risk impacted, and then from there you define what is your cash burn, how much you may need for capex, for refinancing, and so forth. That's the amount of cash you need to hold. Beyond that, you need to think what to do with it, how to get to the optimal capital structure.
Okay, we've talked about some of the strategic responses might be around, they might still involve some sort of hedging, or it might be around optionality or shifting the business around. When they come to the banks to start laying some of this risk off, and the banks are an obvious place to go to, how are the banks dealing with this in terms of capacity? We hear about some banks exiting the market, we hear about extra costs in terms of Basel III and all the rest of it. Are you going to be there for us?
Yes, absolutely. The banking, one thing has not changed in the banking industry. Without clients, we don't have an industry. However, it should be fairly obvious to most of the clients of the banking industry that we are still dealing with some of the systemic issues that we've had to face. And Basel III is pushed out further now to 2019. Some of the regulatory safeguarding that's been instigated since the crisis has yet to be tested effectively in terms of what it stands there for. We absolutely have, and the IMF has identified it, a liquidity change in the markets, and we have a liquidity conversation to have with our clients, and that also revolves around safety and counterpart safety. Who are you dealing with? Why are you dealing with them? The banks are better capitalized now than they ever have been, and are, in my opinion, one of the safest counterparties, but there is an expense that's come with that. And again, it's part of the conversation we have to have with clients. And part of that conversation is, what does the client get for an increased cost of service provision? And we have to have an offering in that space as well.
Yeah, I've got a very technical question about this that has just arrived, and it's basically around when you enter into a derivative, you have to pay for the credit risk. This is the CVA charge, but when you exit it, apparently that evaporates in terms of profit. That's particularly important, of course, in the interest rate market. Is that something that's going to change?
I think the conversation that needs to be had with all customers is one around the clarity of what CVA is all about, what the charge is, why the charge exists, why the charge changes necessarily from asset class to asset class, from duration to duration, from levels of implied volatility changing to other levels of implied volatility. So CVA is exposed to the volatility of volatility, and the volatility of volatility is one of the major underliers for systemic risk issues at the end of the day. It's the speed at which we reprice and the gap between repricing that can often have the biggest impacts. So I would encourage all of our customers to absolutely have conversations with us around CVA to try and demystify some of the myths that do exist and some of the inconsistencies that I think can sometimes become apparent.
Great. Okay. Just a very, very quick question. Do you fear competition? There's quite a few others coming, for example, into the FX execution market.
Well, I think going back to the unpegging of the Swiss franc, that sent a fairly clear sort of message to regulators, to banks, to newcomers to the market about what happens when you have a shift of liquidity, a shift of price provider, a shift of technology, a lack of experience around initial margin and variation margin. And the net result of all of that is, when a market is stress tested, as foreign exchange has been, the people who are there at the end of the day, at the moment, still are the banks. They aren't necessarily the exchanges, and they aren't necessarily the new online providers of best pricing, if that's the tag they would wish to attach to them.
Okay, thanks very much, Jeremy. That's the message for you all out there. Well, we've only got a couple of minutes to go now. We've had a very general overview. Where should perhaps finally a couple of takeaway points. Where should the Treasurer now be focusing his attention?
One thing that I would absolutely say, the treasurers need to make their voice heard. I think they need to take a bigger role. I think they need to provide bigger, louder, more strategic input into the C-suite conversations. Because when companies build their business strategies, they can no longer afford to do that without looking at financial risks.
Jeremy?
I think I'd add, if I'm going to sit here and say that the 50% hedged, 50% unhedged is a slightly old-fashioned way of looking at risk management, or a safe way of looking at risk management, we need to be talking about the other ways that you can still remain comfortably hedged, also comfortably exposed to the underlying market if that's what you want to be, while still at the same time planning for these other more impacting systemic events. And that is something that we haven't necessarily touched on in terms of actual asset class techniques or cross asset class techniques and going back to the matrix, but it is something that we're specifically looking at the ACT conference in Manchester in the workshop that we're delivering there.
Okay, thanks, guys. Well, there's a plug for the. I don't have to make the plug. Well, we've reached the end of our time. Thank you very much for listening. We're going to be putting a recording of this webinar up on our website, along with the presentations that you've seen in a couple of days' time, and we'll be sending you all a link to that. We do have plenty of other future events. If you've enjoyed this one, there's plenty more to look forward to, more webinars, but I would draw your attention particularly to the ACT conference in Manchester from the 20th to the 22nd of May, where indeed Lloyds will be going into a little bit more detail on what we've heard today. Please take time to fill in the feedback survey after the webinar ends. Thank you very much for listening and creating this little piece of history for us. And finally, thank you very much to Jeremy and Yuri and Lloyds Bank. Goodbye.
Thank you.
Thank you.